Hello, everybody, and welcome to this week's podcast with Forte Financial Mortgage Group. This week is kind of a unique and different twist. We have your first-time home buyer, Average Joe, although his name isn't Joe. Please meet Matt. Matt, say hello.
How you guys doing? James, thanks for having me.
It is my pleasure. This is a really cool idea, something that I've been wanting to do for a long time, is to get somebody on here that has never owned a home before, younger generation, doesn't really know what first steps to take, credit, who can buy, who can't buy. There's so many things that are on everyone's minds as a current renter, first-time buyer, and we're going to dig into that. How to get a mortgage. What are the first steps you should take? What should you do 3 months, 6 months in advance of trying to do that? Or how do you even know what your timeline is? So we're going to get into that real simple. A lot of people are nervous and scared to do this, take these steps. So thank you for coming on. This is a real live, this is not a show. Although it is a show, this is actually a real scenario for you viewers to see someone else that perhaps might be in a similar situation as yours. So Matt, why don't you first tell us a little bit about yourself, what you have going on at your stage in your life and where you are and some of your goals and aspirations as far as home ownership, and we'll dig in from there.
Yeah, so again, James, thanks for having me. So I'm 28 years old. I actually own this studio. So I have been renting since, I got out of high school. I started paying my parents' rent. That was more so to teach me, about life and, how hard it can hit you because, anything could happen at any point. So they wanted to teach me a lesson. So I paid rent. And then I got my own place. And ever since I've been paying rent. So, I've been paying, I think at the time it was $500, then $700. And then obviously everything, with inflation, it keeps going up and up. So now I'm paying $2,000 a month. I talk to, people like you and I'm like, you tell me like you could be in a house for less than that. You pay less per month, get a bigger house, you get your own piece of property, your own house, something that you own yourself. And it just gets me thinking like, why don't I just do that? So, that's why where, you come into play where I have so many questions like, where do I begin? Where do I start? What's the first step? And like, I don't have much money. I don't think many people my age have a lot of money. So we don't know, like to me and all my friends, we think that we can't get into a house. So we want to know, like, what are the steps? Like, is it actually easy for us who don't, people my age, even people younger or older, like if we don't have money, what's the first step? Like what should we do? Who should we go see? Who should we talk to? And that's really what we're looking for.
Absolutely. And that's perfect. That's exactly what we're doing here today. So the first step truly is to get educated. And Forte Financial Mortgage Group, our podcast channel, is all about education. That's why we wanted to do this. So, it's probably a little unnerving to just call or walk into your local bank and say, hi, I'm 28 years old. I don't know anything about, buying a house, but I'd like to possibly do that someday. That's not really something you probably would feel comfortable with, right?
No, not at all.
So I think for the first step is we're going to have a great podcast today that's going to answer a lot of these things, and the viewers who are someone else in your situation, younger, renting, wants to learn, they can watch this, and a lot of those questions will be answered for them too. And so, as far as all of that is concerned, the first step is coming up with a timeline. I guess really you can't come up with a timeline if you don't know what's possible. So let's start with answering for the first question about money. You say, hey, I can afford to pay $2,000 a month. That means I could easily afford a $2,000 a month mortgage, right? But don't I need thousands of dollars to go put down, or how would I get qualified? So the first thing is we offer programs that we actually even give the customer like yourself a down payment, where we give you a zero. If you've heard, you as you said it, you run the studio. You've heard us promote our 0% down program, where it's actually a 3% down program. So let's just say, for example, you're buying a $300,000 house, and you would normally have a 3% down payment, which would be $9,000, right? 3%. And then you'd have closing costs on top of that. So that would mean that, something like that in Connecticut could be, let's just say it's $10,000, the closing costs, right? We're taking broad strokes here. We can break some of that down later. But so the point is, now we're talking about, okay, we have $9,000 for a down payment and another $10,000 for closing costs. That's $19,000 I need just to get in. And that's not reasonable for a lot of people, right? So to answer your question, that's not the case. With our program, we give you a 3% down payment. So, and there's a 0% interest rate on that second mortgage. So that means that $9,000 down payment is now gone. You don't need that anymore, okay? And as far as the closing costs, you're going to say, okay, well, James, that's great, but $10,000, I could probably scrape that together somehow, but is there a way to maybe minimize that or get that out of the way? And yes, there is. So there's things that we do, which the most successful tool we've used with this program in particular, and there's a lot of first-time buyer programs that we offer, but we're just kind of talking about one just to give you a general idea. We're trying not to provide too much detail, but enough to give you the basics because they're starting off basics. So there's something called a seller credit that allows the buyer to finance all their closing costs into the loan. So, now you have on this $300,000 example, right? You have your 3% down payment that we're giving you with no payments due, right? At a 0% rate. So now you're at $10,000 you need. So let's just say you wanted to finance $10,000 into your loan. You can't just add that to the loan. It doesn't work that way. What we do is we do via a seller credit. This does require full cooperation with the realtors. So with your realtor, we will get a seller credit, which in this case, if it's $10,000, instead of the seller selling you the house for $300,000, they would sell it to you for $310,000. And at the closing, they would give you a $10,000 seller credit towards your closing costs and what we call prepaids, which we'll get into in a minute. So in this example, you've now are getting into a house with less money than it's going to cost you to rent your next apartment because you're going to have, first month, last month, the security deposit at least. So you're probably going to have, on a $2,000 a month rent, you're going to have at least $6,000, right? You're going to have to put it in your pocket. This was nothing. There's nothing in this case. So to answer the first question, yes, you can buy a home with no money out of your pocket. Okay. What can you buy with no money? What's that payment going to look like? It's probably going to be more than $2,000. We can get into some of that stuff. But that's the first thing. As far as, so for those of you who think you need a lot of money or thousands of dollars to buy a house, you don't, okay? And if you're interested in getting pre-approved for our special program, you can go onto our website, fortefinancial.com, for more information there. We have separate videos and podcasts. I don't want to go into too much more here because I want to focus on answering some of Matt's questions to help educate you. So as far as down payment goes, does that answer questions about the money you would need to do it?
Yeah, absolutely. Because like you said, first and last, like for me, I got to pay $4,000 for me to move in. And so if you're telling me I could just move into a house for nothing and then pay my $2,000 or whatever it is, obviously it's depending on the size of the house, depending on credit and stuff like that, which the credit I do have some questions about. But yeah, like moving into a house is like, for everybody it's scary. And I think it's because that when we were raised, like at my age, when we were growing up, we were taught, 20% down, no matter what, no questions asked. And I think times have changed, and people like my age, which they don't teach in school, any of this stuff, we don't know about this kind of, new programs that they have. Like, I'm sure some of the people my age don't even know about 3% down, first-time home buyers. So, they're thinking, oh man, I need to come up with on a, $140,000 house, whatever, it's, 15, 20 grand, whatever it is, that we don't have that, you know what I mean? And we just turn away the fact that we're going to buy a house because we'll just rent. And I know with renting, obviously you're paying $2,000 and, if the fridge breaks or something, like it's mostly fixed and this and that, and people can look at it that way. But at the same time, you don't own that. So like your whole life, you're paying for something that there's no value to. Once you move out, whoever the landlord is, whoever the owner of the corporation is, just made, a substantial amount of money off of you, and you have nothing to show. Now you're not homeless, but you don't have anything. Now you have to pay a new deposit at a new place. And there's just so many things with renting that like you won't get as a homeowner. You don't, there's that feeling that everybody gets where you own that piece of property. And I think that just, younger age, we're just so accustomed to renting and we're just so like on the same loop. We just, like I said, we don't know that 3%, or in your case at Forte Financial, 0% down. We can literally walk into a house with 0% down. That's astonishing. I haven't heard of any other company that does that. It's still hard for me to believe you. I mean, I clip these videos and I'm like, there's no way this guy's telling the truth. But you've closed on a couple of deals and it's true. I mean, it's insane, but it's true. And I can't wait to get my first house through you. And it's going to be very soon because 0% down I'm tired of paying $2,000 or whatever it was per month for nothing. For me to just move to the next place, and that was just a memory. You know what I mean?
So I love it. I love these questions because I always think of, okay, well, if I was, first time young, like what would I want to know? What I think, though, is very different than someone who's actually in that situation right now. So that brought up a lot of good points. As far as you brought, let's talk quickly about rent to $2,000 versus a mortgage. A $2,000 a month rent is not equal to a $2,000 a month mortgage because there are so many tax benefits from a mortgage that you do not get with rent. So first of all, every month, some of that payment is going towards paying down the loan that you got. All right. Obviously, on a 30-year loan, there's more interest. Well, maybe it's not obvious to everybody. Apologies for that. But on a 30-year mortgage, more of the payment is going towards the interest on the loan in the beginning. And as the years go by and you pay, the interest is less and the principal is more, interest is less, principal is more. But the point is, no matter what, some of that payment is paying down your principal balance, your loan, where on rent, it's doing nothing. That's number one. Number two, the mortgage interest and the taxes are tax deductible, where now as far as talk to your CPA because there are circumstances where there's limitations on the write-off, but this is just a broad stroke, okay? We're not tax advisors, but the point is the mortgage interest and taxes are tax deductible. So what does that mean? What does that mean? Okay, so let's just say you make $100,000 a year. This has nothing to do with you directly. I'm talking about it as an example. And so you make $100,000 a year, you're renting, and you have no write-offs. Now your taxable income is based on $100,000, okay? And you pay taxes based on your W-2 that you made $100,000. Now, if you own a house and you have a mortgage, and let's say it's a $2,000 a month mortgage, and let's say the interest portion, and then we're saying that $2,000 a month includes taxes and homeowners insurance, right? So to be fair, to equal rent. So you're paying those things. You wouldn't have taxes, homeowners insurance on rent. Actually, you may have a renter's policy, so you may still be paying the insurance on a rent. But anyway, let's just say, for example, out of that $2,000, the interest portion of the payment plus the taxes. We're not including the insurance in this. The taxes and the interest portion of that payment are $1,200, $1,300. Right, we'll say $1,250 for actually, let's just make it $1,000. It's just easier. So let's say it's $1,000 a month, right? That $1,000 a month is $12,000 a year. That's the tax deductible amount, which means instead of you paying taxes on $100,000 of income, now you're paying taxes on $88,000 of income. So that extra $12,000 of income, you now made tax-free. So what will happen is most people, they can't adjust the rate of what comes out of their taxes every month with their employer. So they're going to get a pretty significant refund. Whatever tax they paid on that portion of their income, that $12,000 of income, whatever amount is probably 30%, figure 25, 30, that is money back in your pocket. So let's say that is $400, $400, is well, we'll say, okay, so it's $12,000 of your income. We'll say it was about $400 a month, so like $4,500. No, we'll say $400 a month. That's $400 a month more in your pocket, right? So that would mean a $2,000 a month rent versus a $2,000 a month mortgage is not equal. because it's really like you're comparing a $2,000 a month rent to a $1,600 a month mortgage, because that's money you got back in your pocket. Does that make sense?
Yeah, and you own the home. I mean, this is something that,
right, but
like,
the point is, it means like when people
you're saving
think
money. No, absolutely, yeah.
You can actually, the point here is you can actually afford, if you want to compare it apples to apples, you can afford more of a mortgage payment than you can a rent payment when you factor in the tax deductibility. A lot of people don't know that. They don't, or they hear it, but they don't understand what it really means. So I try to give you that example of how that would equate back in your pocket.
Yeah, and I think too, people don't think that way either, like my age, because what we think about is that, you know, we want money now. I mean, everybody wants money now, but nobody thinks like tax returns. Like, you know, obviously for, you know, having this business, you know, I write off, you know, certain things and whatnot, and so I understand the concept. But my friends who just, you know, work at wherever they work and get, you know, the hourly paycheck and stuff, they don't know, like, you know, the whole tax. They you know, in January or February, they just file their taxes, and then they either owe or they don't, which most people owe, because they don't have any like assets that they're writing off. So owning the home, and like I said, those people are renting. So if they owned a home, they would save, like you said, $400 a month or whatever the case may be. Everybody's case is different, but they would be saving that money per month, and they would notice it in just 1 year. The next year, they would see, oh wow, I did get $4,500 back. And then that's all it takes is for that one time for them to see it, because they have no idea. They've never done it. They're just so used to just living that circle, that loop. I'll never be able to own a home because I have to put down 20, 30, 40 grand. I don't have that. I'll never have that saved because it's hard to save that. It is. But with owning a home, you honestly can save that. If you think about it, $4,500 a year, you want, you know, 20 grand, you know, that's roughly a little over 4 years that you would have that saved.
Exactly.
So you would save money just by having an asset, owning a home, rather than renting. You're paying that. You'll never see that money again. It's gone. It's in the wind. And on top of that, when you have a home, you can sell that thing eventually. So realistically, you know, you're paying this much amount of money for the home. Yeah, market goes up and down. You might lose, you might win, but at least you have something, an asset that you could have some. So if some tragic event happened and you had to sell your home, you got money. Yeah. You know what I mean?
One of the things that you brought up too, which is something that is I think down the road is something I want to try to help people and do with regard to, you said, oh, growing up, like we don't learn about this stuff in school. Did you ever go to a class and they said, here's a life class that teaches you about credit, how to prepare to buy a house, what does buying a house versus renting look like? These are life skills that are not taught in school.
Yeah,
correct?
Yeah, you and I, we've been working together for, you know, 3, 4, 5 months now, and I've learned more from your podcast, from your solo videos than I've ever learned in my entire life. And that's no knock on my parents, but they just, you know, they've taught me a few things and here and that, but you're in the industry, you understand it. You know, my parents owned a home and then we started renting. So, you know, everybody comes up from a different situation. So, being able to have you to educate everybody who's an expert, I would say, in the field is really good for people, you know, especially my age, or it really could be any age. I mean, I've met people who are 40 or 50 still renting that just, oh, I've always been this broke my whole life. I'll never be able to own a home, but they can. They can do it.
Fear is a big reason why some people that are older have never done it. I mean, it's unfortunate, and I feel bad about that. But I think the more of those people that see stuff like this might help them overcome some of those fears, and that's our goal. We want to help people. So the point of the education is, like, I would like to down the road, you know, as a personal thing, like to help, you know, schools and college, whatever, to, you know, I think they should bring people in like me to help educate. And you talked about, oh, well, my parents didn't really tell. That's unfortunately, and I don't mean this in a disrespectful way, but a lot of people who are being taught stuff by their parents, it's based on what their parents' own experiences were 20, 30 years ago, which have absolutely nothing to, and not to mention, it was just a personal dealing on a loan. Oh, I hear a lot, oh, go to my bank, you know, that's where I got my mortgage from. When, you know, the reality is, you know, the rates are probably higher than someone like myself. The programs they don't have. Like, there's so many things that they're listening to their parents and not necessarily getting bad information, but they're not getting the best information. So they need to get that from an expert, not from someone who had one dealing and obviously they're looking out for their kids' best interest. I know that, but that's not the right place to go for this kind of information. Watch this podcast, watch other stuff like this. That's what people need to do to learn the most, and up to date. Like we're learning new stuff. I'm learning new stuff, and new programs are changing on a daily basis. Like, so that's why you got to listen to stuff like this. So, the education, that's it, And as far as I want to talk about something now, one of the things people say is, well, how soon can I buy a house? Like, right? You've been doing this studio. So there's a huge difference, and I'll be very honest, there's a lot more or harder for someone who's self-employed to get a mortgage than it is for someone who has a W-2 and a job and a salary, or someone who works hourly. There's so many commission. There's different guidelines for all of that stuff. So and the point of this isn't to get into real detail, but broad strokes, because we could just talk about income and qualifications for an hour, just that alone. So we want to try to keep people on track a little bit. And you're giving me great ideas for future podcasts. We're going to talk about income qualification. How do you qualify income?
Maybe I'll come back on.
Future one, yeah.
Maybe I'll have a house by then.
So somebody who just going to give an example of somebody who just went to college. I know this isn't you, doesn't apply to you, because you're self-employed here now. You're an entrepreneur, which is amazing. I commend you for that. But let's say somebody went to college, they graduated, they just got their first job. They're making whatever, $100,000 a year. They got a great job offer. They just started today, right? I can get that person a mortgage immediately. They don't have to be on that job for a year, 2 years, whatever. They don't have to. A lot of people think, oh, well, I can't buy a house. That's not true. If you have a salary and you just got a job, especially if you just went to college, because we will consider, even though you weren't working, on your application, we'll put, whatever, XYZ college for the previous 4 years. That goes on your loan application, and we'll get your transcripts. And under a lot of our loan programs, we can do a mortgage at that point. This first-time buyer program with zero down and seller credit, we could do for something like that. So feasibly, you could graduate from college, get your job. Instead of going to rent, you can go buy a house with no money down. So I want people to know that you can do that if you just got a job. Now, if you're running a studio for 6 months and you've been self-employed for 6 months, I cannot use that money yet. So no, I cannot get you a mortgage yet. So for someone who's self-employed, we need them to be listen, there's a lot of unique programs we do for people who've been self-employed for less than 2 years. But the standard for conventional type of loans, FHA, VA, government type of loans that we do, your typical basic loans, right? 2 years. You typically need to be established and have owned your own business for 2 years and have filed filed 2 tax returns, really. So, so that is something that we would need to do, a standard, one of these loans that we've been talking about. Now, there's options for people who have been self-employed for less. We do, it's called alternative documentation programs. I would say at least 1 year to get into one of those where we would accept alternative documentation instead of tax returns and everything, which I don't want to get into too much of that right now. Again, trying to keep the broad strokes. So for someone who's self-employed, it's typically 2 years. However, there's options if you're 1 year or less. So just keep that in mind. So you may have to be renting a little bit longer. However, something that can be done too. So say someone like you is, I want to do this now. I can afford it, but I don't meet that requirement yet. You can get a cosigner. You can get a parent to cosign for you to help you qualify and get that now. Okay, and then we can always refinance that loan later, and that's something you hear us talk about a lot. So you can get a cosigner if perhaps it doesn't work on paper, but hey, James, I know I can afford a $2,000 a month mortgage payment right now. I just don't have the 2 years tax returns. And if you have a parent that's willing to cosign, you can do it right now. That's fine.
Would it have an effect on, like, if I was, I've been employed, I was an electrician prior to this. If I had a last year's, I'm just putting this out into perspective. If I had a previous year W-2, let's say 2023 to 2024, I mean, I was working there 2021 to 2024, but, let's say January 2024, we'll just put that into a picture because it's a new year. If I were to do 2023 here and then 2024 self-employed, would I be able to ever use that W-2 information plus that self-employment, or no? Would it have to be 2 years on the?
Yeah. So, and this is a really good question. It's frustrating, but the answer is no. It's great for your application, your employment history, that you have a previous history. That's good. That's great. But any income that is on a tax return or a previous year, it could have been going on for 30 years. And you could make $1 million for the last 30 years. If that is from a source that is no longer going on right now and no longer continuing, we cannot use any of it towards your income on a traditional mortgage. Again, there's a lot of non-traditional stuff we do, but we're talking traditional here for the purpose of this. If you all want to learn more about some of our alternative documentation programs, check out our TikTok, check out our podcast. We talk about specifically for self-employed, and we go into detail on that stuff. But in any event, we can't use anything that's not a current. So that's why it's like, well, you go into someone that just graduated college and they just got a job, they haven't paid a bill in their life, they can get a mortgage. Yeah, they can. This is how conventional loans work. I'm just calling it like it is. I'm not suggesting you should be less or more qualified. Thing is, for self-employed, it's considered more risky because, it's a lot of businesses fail. Let's just be honest. A lot of businesses do fail. So they want to see that you've been able to run your own business for a certain period of time is really the mentality behind that. So, so that's income. That's the basics on income. Now, as far as we went over the whole down payment piece, yes, if you want to put a big down payment down that your parents want to help you out. We get a lot of young people, their parents want to help them out. God bless them. I think it's wonderful. They absolutely can give that money to their children as a gift and put that down payment down. That's something they can do. But aside from that piece of it, I know you had some. I think we should talk a little bit about credit. Do you want to ask questions first about credit?
Definitely, yeah. No, credit's huge because, I don't know what my friends' credit scores are, but I know that some of them are probably not that good. Just from the way they talk, I have no space on my credit card left, so they're probably at 100% usage. Things happen. I try to keep mine down, but things happen, and they, sometimes it'll be over 75% or whatever. So like, what's the rate? What's the best way for someone my age who, I guess I'll start out with, what if you have 100% usage on your cards, but you have 100% on-time payments, you've maxed out every card? Is there a way to still apply and like, is it possible? And
Perfect.
Obviously, it depends on your credit score too.
Such good questions. I'm so glad, Matt, you brought this up. So first of all, with credit, I suggest anyone watching this who's interested in credit to watch our previous podcasts. Just go to our the links should be below in our, if depending if you're watching our YouTube, the full podcast is on our YouTube. The shortened clips will be on TikTok, Instagram, and Facebook. But if you're watching this podcast, that means you're on our YouTube channel. The last podcast we did before this with our credit expert, Noel Gill, he went into great detail about the effects of credit card usage, limits. So we're going to touch on it quick here. First and foremost, anyone, I don't care, even if you think you're not ready, you're not going to do anything, you should be looking at your credit. There's a lot of different ways that people do it. Now, a lot of the most popular one in here is Credit Karma. I'm sure you've heard of Credit Karma before. It's a great tool to give you a general idea of what's going on. It's not the best tool in terms of accuracy of scores because again, watch the full podcast so Noel, we break this all down. But as far as scores go, there's many different scoring models. And Credit Karma's scoring models that they look at when they give you scores aren't the same ones as a mortgage company would utilize. And what happens typically is those scores are usually a bit higher than your mortgage type related scores, your different FICO models. So, but again, as a rule of thumb, it's going to give you the basic information in your credit report. Now, credit cards, if you're maxed out on your credit cards, that your scores are going to take a hit, even if it's paid perfectly on time. A lot of people think, oh, well, I have made a bill late, and we pull their credit, and they have a 620 score. And there's not one late. They have a long credit history of 10 years. They don't have one late. They have a 620 score, which isn't great, Just to discuss scores in general, excellent scores, are scores in the 700s, and as high in the 700s as possible to 800 is kind of like, hey, I want to be at the best. If you want to be at the best, you want to shoot for high 7s to 8. Now, as far as from a mortgage perspective, every program's different, and like one thing that we talk about a lot is FHA loans. One thing is if someone has lower credit scores, FHA loans usually are much better for them because the rates are very attractive, and the lower scores aren't hurt as much as on a conventional type of loan, which is a different loan. I don't want to get too technical here, but the point of this is the different types of loans will allow for different scores. But as far as credit cards go, yeah, I mean, you really want to strive to keep those balances, as low in ratio to the limit as you can. I mean, that's really just the general advice there because that will make a big effect. I've seen people who have maxed out credit cards, pay them down, and have their credit scores jump from 620 to over 700 like that. We do a lot of rescoring where we help our borrowers. They might come in the door and, James, this is my situation. We're trying to buy a house. I'm like, yeah, we can get you in with that, but hey, Matt, by the way, I see that you have, and this isn't Matt, by the way, this is just talking out loud here. Matt, I see you have, these 4 credit cards here, and I can run a cool little simulator in my systems where I'll say, hey, if you pay down this Chase credit card from a $4,000 balance down to, $1,500, you have a potential score increase of like 32 points. That's just an example. So we do that to help our people. So the point is, even if you're not ready today, you should submit your loan application. And it's free education. We don't charge our borrowers, to get pre-approved and help guide them because the point is, hey, we're educating people, and at some point down the road, they are going to be homeowners, and we hope that they come back to us at that point when they're ready. So. Credit scores. So if you have maxed out credit cards, yeah, your scores are going to go down. So the point is to try to keep those balances. So if you have good point. If you have $10,000 that you were thinking about putting down in a house, you would actually be better off in a case with credit card debt, paying down those credit cards and doing a 0% program because your scores are going to be a lot better and the terms you're going to get on your loan are going to be better. And plus, now that you have more of that money is tax deductible than those credit cards, which aren't, right?
Yeah, absolutely.
So that's a point there. I can keep going off on tangents. I'd rather you ask me more questions, though.
Yeah, no. So another question I had was, So some of my friends, I myself have quite a few credit cards. Not a good thing. I did it when I was young.
It happens,
but. Some of my friends either have one credit card or no credit cards. They have no credit history at all. I try to tell them, but they don't listen. Mm-hmm. But what for people like that? If they have no credit history, one credit card with a minimum balance, like what's some info on that people can try and get in?
Great question. We cover that in detail on the No podcast, but to touch on that quickly, if you have a parent that has good credit and perhaps they can add you as an authorized user on their account. Make sure it's a good account that has a good balance with a low, or good limit with a low balance ratio. You don't want something that's maxed out. But a parent adding you on as an authorized user on one of their accounts is a great tool to give you more trade lines without actually having to open up debt. But if you don't have any credit cards in your name, let's just say you're just using your Visa, MasterCard debit to pay for everything, then I highly suggest you get a credit card. Lots of times someone has no credit card, they will have to go to their bank and start out with one of those types of credit cards that, they give you a small limit. I mean, you definitely want to start out getting cards, using them, pay them every month. Instead of using your debit card, I'm not suggesting anyone rack up credit card debt, but what I'm suggesting is they get a real credit card that's not a debit card, pay all their gas, groceries on that, and then pay that every month. Everyone should be doing that if you're young and you don't have any credit cards, because that is how you help build up your credit report, which, yeah, if you have nothing on your credit, you may have no credit scores. And, you need to have credit scores for most loan programs to qualify. Yeah, there's some limited stuff that we can do with no scores, but when we get people with no scores, we help educate them on what they can do to get those scores. And being added as an authorized user and opening up a credit card, those are really the two best things somebody can do. In a lot of cases, depending on who you're renting from too, we can get a management. If it's a management company, one of the things the Kelly Group does that we work with, they will get that added onto the your credit report as a trade line. So like that's a pretty cool tool is getting that. That doesn't work with a lot of private stuff, but with management companies, we've seen that done before. We've helped people do that. So that's another tool as well that we can use.
So to tap into like a smaller market, it might not be as small as I would think it is, but people who have no parents, people who maybe their parents aren't rich, have no money, have no credit, but are still with them, or deceased, whatever the case may be, people with no parents. I've done a little bit of research on it, but can you enlighten, could you co-sign with a friend? Could you apply for a mortgage with a friend, with a cousin, an uncle or aunt, whatever the case may be? It doesn't have to be your parents, right? You could do
Correct.
Anybody.
There are different programs that will have different requirements, but as far as for mostly those requirements are for gifts. But as far as buying a house, you can buy a house with anyone you want. Now, as far as if it's a friend, there's obviously going to be a piece to it that the questions on both sides. Let's just say it's you and your buddy John. We're just talking out loud. You're going to state on your application, is this the purpose of this to be your primary residence, or you're going to rent it? Is this an investment property for you? And you're going to, obviously, in your case, you'd be your primary residence. Now, what's the deal with your friend? Is your friend also going to live there, or is this an investment property technically for them because they're not going to live there and they're just co-signing for you? And that's either way, it's fine. We still consider for loan purposes that it's a primary residence. So you get, because loan terms are better as a primary residence than an investment property, right? Because they're more risky. So we would still consider for loan purposes as a primary residence, even if your friend John was not going to live in it with you, but they're just trying to help you out and co-sign. The important thing is, though, if John wants to co-sign, it's everyone's income, everyone's credit, and everyone's debts are all kind of mashed together, and the overall qualification is based on the overall. So his income plus your income, his debts plus your debts. So we're going to take, let's say John's renting and paying $2,000 a month. We're going to have to add that into the calculation too. So everyone's debts have to make it work. So, but yes, in theory, John can co-sign for you, who's just your friend, and he's not related to you, to help you qualify for the house. He can do that.
Okay, yeah. So then, I mean, we touched on a lot of stuff. I think the next step would be getting into the home, and after the whole beginning process of like purchasing the home, going through the mortgage, closing on the home and stuff. People,
how about? That brought up a great thought. If you don't mind me interrupting you,
you probably are going to take my question right out of my head.
Well, no, it's just how long does this whole process take? Was that your question?
Yeah, I was going to say. I mean, you're closed. Like, I guess that was really I was trying to fill that gap. You're first looking for a home. You found your mortgage broker. You found everything you need. You found your home. How long does that take for me to be able to close and move in and begin? Just because looking at it from a renter's point of view. Maybe I want to plan this perfectly so that I can move into the home when my lease is up, so I don't lose my deposit. Because a lot of the times, if every time you cut your lease early, that's the whole point in first and last is to keep your last month. So, is there a way to plan that and make that doable?
Absolutely, there are some moving parts, but as far as to try not to go too crazy on this question, we make homeowners start to finish in as quickly as everyone else wants to move. And what I mean by that is, and a lot of people just, they don't believe it when they first hear it, but so for us, in order to get you a mortgage, okay, let's assume you found a house, you want to buy it, right? If everyone else is on board, what I mean by that is, I mean the seller, attorneys, everyone that's going to be involved with this, we can do that from the first conversation I'm having with you to you owning that home in less than 30 days. That can happen in less than 30 days, okay? And, again, the reality is if you're just starting today, you're not going to own a home in 30 days because it's just because it won't happen that quickly from a regard of you're not going to find that would assume you're finding the house in like tomorrow, and then you have an accepted offer like the next day. That's not going to happen that quick. So let's talk about the steps quickly. So the first step is you get pre-approved. What does that look like? With Forte Financial, you would go on our website, fortefinancial.com, and you would submit your loan. Click apply now. It'll take you 5 minutes to submit your loan application to us. That's step one. Step two, a loan officer, whether it's myself or one of my team members, we review that application online. We do a soft pull only on your credit, and that's important because anytime someone does a hard pull, it's a hard inquiry in your credit report, which depending, and again, this refer back to Noel's our credit video. It will have a different effect on everybody based on everything else going on with your score, whether it goes down or not. Because there's a big misconception. Every time someone pulls your credit, your score goes down. And that's not exactly how it works. However, it can drop your score depending on the circumstances. But the point is, we pull your credit with a soft pull. There's no effect on you because it doesn't count as an inquiry. So we review your credit. And let's say everything's perfect, we'll ask you for, you can upload some of your income documentation, assets, whatever we ask you for, you upload to our site. Very simple. You can email it to us, drop it off. It doesn't matter. And then from there, it takes us 24 hours or less usually same day to, figure out what you're pre-approved for. And we say, okay, Matt, awesome. Congrats. You are pre-approved 24 hours later. So what I like to do personally is I say, okay, give me an example of something that you think you're interested in. If you want me to be able to show you what you're even approved for, or what would a $200,000 condo look like per month? What does that even look like? I would ask you, Matt, to provide, hey, send me a link or two of some condos or houses that you found online that you think you're interested in. So I can use that, even if it's sold already, but let me use it as an example. So I get that example from you. 123 Main Street is on for $250,000. Let's pull that up. And let's say your program is this 100% financing, this no money down program. I run that through the system with all the taxes, all the information on 123 Main Street. And I send you a detailed email initially and say, hey, Matt, if you wanted to buy 123 Main Street, assuming your purchase price was $250,000, here's a very good idea of what your whole breakdown, the monthly payment with principal, interest, rate, term, taxes, homeowners insurance. Here's a good close estimate of what that's going to look like for you per month. And like, wow, James, that's cheaper than me renting. It's great. So then we issue you usually a property-specific pre-approval letter, because realtors typically want not just a general pre-approval letter, but hey, they want to see that you're qualified to buy 123 Main Street. So we issue that pre-approval letter. Your realtor submit, you go and look at it, you love it, you want to put an offer. Great, you put it, you have your letter now that you go in, you put an offer with your realtor, and you negotiate. Let's just say you negotiate, they accept, you come to terms. Great, you have an accepted offer. The next step from there, you would typically get a home inspection done. I know there's a lot of people have been waiving those, and with the craze with COVID and inventory, but certainly that's the normal process, is that you would get a home inspection. You find that suitable, you're happy, you move forward. You get a formal contract on the house, because the initial offer in most cases is just a preliminary agreed offer between buyer and seller. Then you meet with your attorney at that point, which your realtor or your mortgage person will have helped, or maybe you already had someone involved. Whoever that is, they get involved. You iron out the details of that contract. And that's part of what we need as the lender. We get that contract with all of your income, assets, your driver's license, everything we ask for. Now you go into underwriting and processing. For us, that's 24 hours. Once I have all that, 24 hours. We also will order what's called our appraisal at that point, where we need to make sure that the house or the condo you're buying is worth what you're paying, okay? So we will base our loan based on that. So, we want to see that it's worth what you're paying. So assuming it comes in at price, because again, we don't want to go into all the what ifs right now. This could be hours, this podcast. And everything looks good. The appraisal comes back fine. Your loan is approved in 24 hours on our end. And we issue a loan commitment. and it says, hey, this loan commitment is just subject to these couple of things: a title work from your attorney, a homeowner's insurance policy, maybe a verification that you're, if you were putting a down payment, that has cleared. And, we can close as soon as, we have those things. We'll issue a clear to close. And that's really that process. You get your clear to close, you go meet with your attorney, you sign papers, and there's your keys. And now you own a house.
It's that fast.
It is that fast.
It's that easy, too.
It is that easy.
The legwork. Because I think a lot of people my age, too, we're thinking that you're buying a home, it takes 30 days to do this. This person's got to do this. This person's another 30 days. You know how people are, with their jobs. Some people are lackadaisical. In my eyes, I'd want to get it done because that's how everybody gets paid. But you know how people are. So I think that we think that it takes 2 to 3 to 4 months even to get in the house. And so for me to prepare for something like that while renting my apartment, I'd want to plan ahead. And it's good to know that it's probably going to take about 30 days. And then obviously given with the seller and stuff when they move out. But so generally what you're saying is it should be about 30 to 60 days
from the point you're pre-approved by, let's say, Forte Financial. From that point, even though that process can take 24 hours, my point is, you or the viewers watching that want to do this and plan, get pre-approved months before you think you're ready. You should. Because, hey, first of all, there may be things in your credit or maybe other things about your credit profile like job, income, documentation, a lot of stuff like that we may, you may need to clean something up or do something. And we can say, oh, hey, Matt, listen, you're looking pretty good here, but I suggest you do this, that, and this to put yourself in a better situation, or I need you to do this before we can pre-approve you. This could be a lot of different things, so we always try to tell people, listen, if you want to buy a house in, 6 months from now, don't wait until 5 months to start the process because you don't know what's going to come up. Hey, a lot of people, they come in the door and everything's perfect. It's great. Yep. Yeah. Here's your pre-approval same day. And they find a house and they close in 30 days. That happens all the time too. But just give yourself the time. Yeah, we don't need it because plus you got to remember, there's a whole seller side. There's attorneys on both sides. Mm-hmm. Everyone's got to do their job. It's not just me, the mortgage company. That's what we get. You get a lot of stress sometimes when I'm like, listen, guys, we don't control the whole process. We only control approving you, yet approving you also is contingent upon other parties involved getting us things that we need, like attorneys, not waiting until the last minute to order a title on the house, and then come to find out they ordered the title and there's a judgment lien on the seller that nobody knew about. There's so many things like that could pop up to delay things. So we're just talking about the hypothetical situation of what's reasonable and realistic. Stuff can come up that's unforeseen to delay it, but it is very possible 30 days buy your first house as a first-time buyer.
Yeah, and that's like the perfect scenario, obviously.
Yeah.
I have a question now that would lead to probably a lot of people that have concerns about it. If I were to get pre-approved and then say that's 3 or 4 months prior, and there's two things I wanted to ask about. Was what if you lose your job during that time? So that's one of them. Lose your job, quit your job, switch jobs, make more money, make less money. That's one of them. And then my other one was that if you're, during the pre-approval process or whatever, the same kind of concept. What if you still have your same job, you still have everything, but you wanted to buy furniture or something for your new home, or you wanted to purchase, like a new, obviously you don't own the home yet, so maybe a new deck would be a little ridiculous, but you wanted to furnish a home, you're at the point in the process where you're going to get the home. So I guess this is, way after the pre-approval, but the losing the job, and then also I want to buy furniture for it. When can I do all that?
Great questions, Matt. Thank you. These are great questions. First of all, let's talk about the job first. If you lose your job, that pre-approval is done. That pre-approval is subject, it's subject to a lot of things, like you keeping your job, and a pre-approval is just a pre-approval. It's not a loan commitment. A loan commitment is when you actually have the property picked out, you have the accepted offer, and you go through the whole underwriting process. So we're going to want to see those pay stubs. We're going to want to see all that. And we're going to take that. So let's say we cleared, this might be a little nerve-wracking for you and everyone else, but what's going to happen, this isn't just Forte Financial. This is a standard in the mortgage industry. Banks, brokers, lenders, it doesn't matter. It's all pretty standard. You're going to get pre-approved, then your loan approved through underwriting, and then your loan cleared to close. Like, hey, you're clear to close. There is a final verification of employment that all lenders do within 3 days, typically 3 days of closing. Some will do it within 5 or 7, but most lenders will wait till 3 days or even 1 or 2 days before closing, purposely to make sure you still have a job before they allow it to close. So your whole loan could be clear to close, and I've been doing this for a long time. Unfortunately, I've seen this happen too many times where somebody, and mostly it's because people quit their job, not because they were fired or let go or lost their job for whatever reason. They'll just quit their job, and then the deal is dead at that point. We will not lend even if we've issued a clear to close. If you've lost your job, and when we call the employer to verify if you're still there, it's a verbal verification. And if they say, sorry, no, she's not here anymore, or he's not here anymore, it's no, that's a problem. However, let's talk about switching jobs. Now, if you switch jobs, we have to reassess it at that point. If it's a salary, you going from a salary to salary, and it's just a different company, same line of work, no problem. That's fine. We're just going to use that new income, whatever that is, and adjust it up or down if it's more or less, and you're right back on track. Easy. Now, if you were an electrician making a salary hourly for the last 4 years, and now you said, James, great news, I just opened up my own studio, I'm making a lot more money now, and you're self-employed, I'm like, all right, Matt, that's a real problem right now, because you can't just switch to self-employed without showing a history of being able to run your own business, which we talked about earlier in the podcast. So that would be a problem there. Now, same thing with, let's talk about something that's a little bit more in between. Someone that was, let's say they were getting a salary at their job, whatever, they were a manager, they were a store manager. Now they changed jobs or changed positions to, now I'm 100% commission, right? Instead of a salary. That's an issue. So to use commissions, we use an average, typically, most programs, an average of 2 years. So if you just started making commissions and you're like, I'm making $10,000 a month commission, I mean, great, you've been making commission for 1 month. We can't use that. We cannot use that commission until it's been established. So yeah, it is harder for people who are just starting out new jobs if they're self-employed or commissioned to get a mortgage. Much harder. So let's talk briefly about the debt. We always advise our customers, don't open up new debt while you're trying to do the mortgage. You can. However, what's going to typically happen is towards the end of the underwriting process, we'll do what's called another soft pull. We talked about the soft pull earlier, purposely to see if you've opened up any new debt. And if there's an inquiry on your credit report that's since the original pull, we're going to say, hey, Matt, we see on, October, 20th, you went and got your credit pulled here from, Bob's Furniture. Can you just, what was this for? And did this result in any new debt being opened? And you have to answer. And if the answer is yes, I just bought couches as, $5,000 I just spent on furniture for my new house, of course. Then we're going to say, okay, no problem. We need to now see that debt, the proof of that, what's the term of that new debt, and we have to now add that into your debt, your debt schedule, and make sure your debt to income ratio can support adding that with everything else. So it kind of goes back to underwriting when that happens. So we just say just wait till after closing if you can. If you can't, we understand, but just understand this is what we're going to ask you to provide us. And in this case, I'm like, all right, Matt. Well, if you can't wait, like, what do you think you're looking at? And he's, James, it's like about $5,000, and we'll figure out an estimated payment for what that $5,000 is. I'll make sure, you qualify fine. It's not going to hurt you based on everything else. So, but we try to avoid it. If possible.
Yeah, I think we touched up on a lot of stuff. I think that was really good. I think we should do more of this because there's questions that are after. I mean, we could, like you said, we could talk for hours.
Yeah, we'll do a
There's
follow up.
so many-
I don't like to go too long on these things because then you just get lost in it. I think it was a great first time buyer video.
Yeah, I know.
Right?
It's exciting.
I love
nerve-wracking,
having people like you that are thinking of things differently than maybe myself, and I don't know how to answer stuff if I'm not thinking about it like you. So this is really helpful.
Yeah, because
to
I
be able
mean,
to
a
help
lot of people my age too, like we want to buy homes. I mean, some people don't. Some people just want to rent. But we want to buy homes typically, and you want to own your own home and stuff. But I mean, I could name maybe a handful of people that are my age that own a home, and maybe I'm hanging out with different friends. But for the most part, a lot of people, the majority of America at this age doesn't own a home. It's statistically proven, or they can't afford it. They think they can't afford it. It's like we just don't know about it. We don't have resources for it, and we're not going to go out of our way to look for that because we know what we hear and we believe what we hear, and that's it. And going back to the parent thing, they're going to teach you what they knew 20 years ago. They don't know what's going on now. They don't know the new rates because either they still own the same home, it's probably paid off or close to being paid off. They're not interested in this whole refinancing and first-time home buying because they're not buying a home.
Yeah.
So they're not going to tell us about information they don't know about unless they're doing research or unless there's somebody in the field like you where they could help us explain it. And I love the whole going into schools, to colleges. I think that's a great idea. I think that would help younger generations, below us, learn how to buy a home and get into it.
For sure. No, this is awesome. Yeah. Thank you, Matt. This has been really great. Hopefully you've learned a lot, and you can share this also with some of your friends that may be interested in learning more about this and help educate people. So, reach out to us if you all want more information. Check out our educational section on our website at fortefinancial.com. You can watch all of our videos there where we talk about specifically some of this credit stuff, first-time buyer programs. There's a lot of great educational podcasts there, and a lot more to come as this has brought up a lot more, just questions. And I think we'll do one on just income, and we'll just totally just dig into income. Another one with down payments and assets and transferring money. And hey, we have a mattress full of cash. What do we do with that? Lots of stuff happening with those things. So more to come next. Matt, thank you so much for being with us today. Hope you all enjoyed. Let us know what else we can do to help you guys become first-time buyers. Thank you.